Good afternoon, everyone, and welcome. Thank you for joining our Fraud Trends webinar. I'm Sherol Prince, the Director of Identity Management and Fraud Consulting here at Equifax, and I'll be providing you with an overview of our 2022 fraud trends with a highlight and focus specifically on the last quarter. Now, also joining me today is Brady Harrison from Kount, the Director of Customer Analytics, Solutions, and Delivery. We also have Julie Kuzmic, Senior Compliance Officer in Consumer Advocacy, both here to provide some additional insight into what we're seeing in the market. Now, just before we get started, I'd like to turn it over to my colleague, Sandra, just for a little housekeeping rules. Sandra, over to you.
Thanks very much, Sherol, and good afternoon, everyone. Each area within the On24 webinar platform is responsive, so you can maximize or minimize your widget or box that's on your screen based on your viewing needs. There's an Ask a Question widget under the slide area, so feel free to enter any questions you may have, and we'll try and address them throughout our session today. In the event there's too many questions to get through, we'll generate an FAQ document, which we'll send out to you in the coming weeks. Today's presentation in English and French is available for download in the related content area, and our session is being recorded, and you will receive the on-demand link via email tomorrow. Some additional features you'll notice on the bottom of your screen are Register Now for our upcoming Consumer Trends webinar on March the 7th, a survey that will pop up at the end of the webinar, and Contact Us. Feel free to check any of these out and provide your feedback. Now let's get started. Sherol, back to you.
Thank you, Sandra. So I want to give a short economic update so we can see fraud. So as we look back at the last quarter of 2022, we started to hear and see the impacts of changing interest rates and the challenges it was having on the economy. We continued to see supply chain issues, and the Bank of Canada, as you see here depicted in the chart on the right, continued to aggressively raise interest rates. This was to help curb inflation, and this is where we can see a little bit more detail here on the chart on the left. We see that inflation really remained higher than it has in previous years, with prices continuing to rise despite the slowdown in inflation. We do see the highs of inflation starting to show some cooling down. However, the raise from the interest rates really hasn't had an impact as yet. So we're starting to see where these trends are going to take us. And as I dive a little bit more in detail with the fraud trends, we're going to start to see how the challenges the economy has had over the last year is really driving and impacting some of the fraud that we're seeing. Now, just before I dive into the trends, I thought I'd like to get a little bit of feedback from you. What do you think we're seeing from a fraud perspective today? So I've pulled up a survey here, and I'd like to get your thoughts. What do you think is the most common type of fraud? Online or digital fraud? Or would it be synthetic identity fraud, essentially fraudsters creating fake identities? Or first-party fraud, where we have the consumer themselves committing the fraud? Or what we're seeing around third-party fraud risks, maybe scams or through breaches, we have fraudsters taking over individual identities. So where do you think things are going? Give everyone just a few seconds to get their vote in. Just see a few more people getting them in as the numbers go up. Be interesting to see, and I'd love to see how this ties back to what we saw at the end of the quarter. Again, give everyone a few more seconds. Okay, why don't we take a look here? Interesting. So online fraud has come up at the highest at 44%, followed by synthetic identity fraud, which is quite interesting. Definitely two fraud trends that we've definitely seen over the last year. So why don't we take a dive into the fraud trends? I thank everyone for their insights, and let's see really where we ended up last year. Okay, if you take a look at the overall application volume in the last quarter, we started to see strong growth in overall demand for credit as we saw consumers shopping, looking for additional credit, credit cards, auto loans, unsecured loans. We saw a large increase, and this is depicted by the gray bars over in the chart on the left. You also see a steady increase in both the application volume as well as the rate of fraud, which you see depicted here by the red line. There was a surge in volumes, I would say, towards the latter part of the year. And we also saw a little bit of a drop in applications just towards the end. Now, what we have seen is fraud rates have been increasing, and there appears to be a return to what I'd say is pre-pandemic levels. We're actually seeing a little bit larger than normal increase, even when we look at some of the seasonal changes. Now, what we initially saw as some volatility at different parts of the year, there was an upward trend, and that explains some of the reason for the drop in the fraud rate that we saw initially. However, fraud is continuing to rise. And with the application volume, we're linking those two and seeing that there's got to be a little bit more here at play. Now, when you take a look at the chart on the right, we're looking at fraud rate broken down by first party and third party. Now, what you see in the overall chart here is that third party rates have been increasing significantly. And this can be attributed to identity fraud. I believe the economic conditions that we did speak about earlier are having a real impact and are driving a lot of these rates that we are seeing. We see this with the continued financial stress, as well as the overall changes in consumer behavior. So now let's take a look at how this is impacting the overall fraud from a perspective of how they're actually considered suspicious. So the types of applications, how they're coming in and considered suspicious. So through our fraud exchange, our platform allows our members to tag fraud applications with the reasons as to why they believe the application is fraudulent. So if you take a look at these top two reason codes, you're seeing that suspicious activity has been highlighted around identity fraud as well as digital fraud, rounding up as sort of the two top level frauds that we're seeing in the industry as indicated by our members. Basically, both are on the rise, and we're seeing the impacts, again, that the economy is having on both of these trends. We did initially see identity fraud sort of on a downward trend. It was beginning to slow, sort of through the midpoint of last year, I would say. But what we have seen now is a steady increase. Now, I want to take a look at specific industries so we can see exactly what's happening with these patterns and trends and how they're impacting specific industries such as mortgage, auto, and so on. So why don't we dive into the mortgage industry first? Now, as you see here, mortgage fraud rates rise as application volume declines. So we have seen a significant drop in mortgage application volume. And you will see that as we take a look at the market, a lot of what we're seeing in the economy has been having a huge effect. So we've seen a decrease in the housing value, we've seen availability be a continued issue. And this is all compounded with the interest rate hikes and lack of affordability. So what does this mean? it makes sense that application volumes have been declining, and we see the economy having a clear impact on that. Now, when you look at the fraud rate, you will see it's significantly increased. Now, this is somewhat misleading when we look at the mortgage space, as the significant decrease in application volume is actually artificially making the fraud rate appear higher. So here we would say we're still sort of seeing the same trends, but with the application volume down, it does appear as if the fraud rate is higher when in fact it's relatively been somewhat stable. Now, when we look at the biggest impact on the mortgage market, we see the hottest areas are the areas where we're seeing the slowdown. So if you take a look at Ontario and BC, you see between 30 up to 40% decline year over year in application volume. We also see, if you look at the chart on the right, that falsified financials continues to be the biggest concern when it comes to mortgage applications. Now, if we move on to the auto industry, you can see there was a downward trend in the application volume. However, with the fraud rate, we see a very significant increase. The rates of fraud are increasing at a pace that we haven't really seen since before the pandemic. And you see this both month over month and year over year, significant increases from 43% to 31%. Now, really, what's driving these increases? And I think there are a few things at play, the volatile market certainly being one, but I'll touch on in the next segment a little bit more what's happening from a fraud perspective. Now, if we take a look at the auto applications, we do see some different patterns, and it's likely in regards to the overall vehicle availability. So we do see some changes in application volume, and we do see how that's having a different impact in the volume of accounts throughout Canada. So overall, I would say when we take a look at all of the provinces, we're looking at a volume of new accounts still below pre-pandemic limits in almost every region, but you will see, with the exception of Quebec, as well as Atlantic Canada coming closely behind. And for auto, when we take a look at the reason codes, what's considered suspicious from an application perspective, I would say similar to our last update, first-party fraud remained the biggest threat for auto. That said, we are starting to see an interesting trend, an increase in third-party fraud applications, and this is related to identity theft. A concern that I am hearing from clients, as I've had several conversations with individuals in the auto space, and this is a rising concern. Now, when we take a look at credit cards, we do see that the credit card industry continues to be volatile, and you're definitely seeing that here in the both in the application volume and in the fraud rate over the last year. We see somewhat of a month over month and year over year downward trend, but it's still a strong demand overall. And we're seeing this trend increase as fraud rates are starting to surpass pre-pandemic limits. So why are we seeing such a rapid increase? Well, I think really, as the headline states, the strong growth in credit cards is driving up application volume as well as the fraud rates. And I would say the main driving force that we've seen is due to some attacks that were happening quite specifically last year. And this is not to say that it only impacted the credit card market, but this is where I mentioned something else going on in the auto space as well. We believe these targeted attacks have been driving up the fraud rates, specifically in credit cards and as well in auto. And we're hearing from other clients in the retail space that they've been seeing similar increases. So definitely something we will be watching in the year ahead. Now, when we take a look over here, just take a look at the fraud rate again, 7% month over month, and just at 78% year over year. Again, something we're watching and looking at when we're talking with our clients about how to look at different ways to address the third-party fraud and identity theft concerns. Now, when we take a look at the overall fraud rates, they are significantly up across all provinces. And while not every province has had some significant spikes, we are seeing a stable thread throughout. And you can see that here in the chart below that speaks to the overall fraud rate at the bottom. Now, I want to really turn over to the chart on the left where we see identity theft continuing to be the biggest threat. This is now accounting for 70% of all credit card application fraud. Again, this speaks to what we're seeing in the economy, but as well, it speaks to the targeted attacks that we have seen hitting not just the credit card, but multiple industries last year. That has had a driving effect in the overall fraud rate. Now, if we turn to overall banking deposit, we now see the application volume here has been down month over month, but still remains fairly high. Now, when we compare it year over year, it still is higher than pre-pandemic times. And I think the reason for this is somewhat clear. When we look at the overall pandemic and the impacts that it's had over the past year, we saw a change in consumer behaviors. We know that in-person banking practically stopped. And now that we see access to incentives and benefits for COVID have now sort of surpassed their use, we're seeing fraudsters starting to move on to other methods. And this is where we're seeing the spike in other unsecured lending being driven up. Again, directly as a result of fraudsters moving to another form where they can use the same skills they did in the pandemic on deposit accounts, but sort of move them over to other areas. We expect this is going to continue to increase. And that doesn't mean that there shouldn't be concerns around first-party fraud. Again, we are still seeing that that is starting to have an impact. And if we take a look here, you do see to the right, identity fraud threat was much lower in 2022, with deposits being down. This aligns to what we saw again from the pandemic, where fraudsters were taking advantage of the COVID benefits, and then they decided to now morph and move over to different frauds as we started to see that trend in the last year. Now I'm just going to touch on telco fraud. This industry's been stable when it comes to fraud rates. They still are well below pre-pandemic times. And we do see that application volume is up slightly month over month, as well as year over year. And I think this new account demand is starting to slowly increase as we are seeing some strong growth in inquiries. So I do anticipate that to grow. Now, if we take a look at what are some of the fraud reasons, well, we see identity fraud is much higher portion of fraud in the last quarter than it was 1 year ago. Interestingly, we also found that in BC, if you take a look at the chart above, in BC and Alberta, we saw telco fraud rates were much higher than pre-pandemic times. Now, I just want to highlight a few things that we've gone through, just some key takeaways and points. So really, when we look at it, overall, identity theft is growing. It's a growing concern in the credit card space as we do see increased demand. We also see and hear constant stories of breaches and cyber attacks, and this gives fraudsters continued access to exploit consumers' personal data. this impacts the increase in identity theft that we continue to see rising. We also see debt levels and financial stress indicators have been rising. Again, potential for increase in first-party fraud. We're also seeing new credit demand and strong growth in unsecured lending having an impact. What does this all mean for us? Well, I see overall, I would say that fraud is masking itself in different ways, especially during an economic downturn. And so we need to be vigilant. Essentially, I would say you can't take your foot off the gas. You have to make sure that you're looking at and monitoring these different fraud trends. So as we wrapped up the year, this is where we've seen things going. Definitely third-party fraud, identity theft, a concern, but that doesn't mean we don't want to stay and watch and be vigilant around other types of frauds as well. So with that, I'd like to move over to Brady to talk about some of the emerging trends that he's been seeing at Kount. So Brady, with that, I'd like to turn it over to you.
Hi, thank you all for having me. I'm going to talk a little bit about some recent fraud trends. Again, I'm Brady Harrison. I work on customer performance and fraud tracking at Kount. Kount has been a member, part of the Equifax family going on 2 years, specific to identity and risk management when it comes to any digital or physical interaction. So today I'm going to talk about 3 major fraud trends that we're seeing in Canada and extending in many ways worldwide. First and foremost, this may be unfortunately close to home for many of us. We're starting to see a large increase in elder abuse and exploitation. One of the shifts here is that we've historically seen, that kind of first-party abuse, unfortunately, was common. We're actually seeing it extend out to third parties. So while historically it may have been a vulnerable parent or family member who is taken advantage of by someone close to them, we're starting to see these members of the greatest generation get tricked into spending a large percentage of their annual income on financial instruments or cash transfers, guised as investment schemes, romance scams, any kind of scam in general, right? If you've ever got a phone call from a elderly parent asking if you are actually in jail, or the government is asking for gift cards to pay their taxes, this is really where this stuff is happening overall. So in essence, that abuse is older customers actually tricked into large payments for financial instruments or cash transfers. Sometimes it's cryptocurrency, sometimes it's individual payments. So not just a tight relationship here. The Elder Abuse Prevention of Canada reports that about 1 in 25 Canadians say they're a victim of investment fraud, though only 1 in 3 who have actually been approached have reported it. So we're seeing a large increase in this. I actually, just before this webinar started, got a text message that I believe is a romance scam first message. If you ever get a text message out of nowhere asking someone, "Oh, how are you?" Those are generally someone fishing for someone who's vulnerable, looking for a connection that they can ultimately turn into funds. So how do we kind of prevent this, right? We see about Canadians losing about $60 million to these romance scams in the last year. And so one way that we can identify this, especially for people who are especially vulnerable, are deriving insights. Can we provide some more granular detail on that first party abuse, where we're maybe getting past the normal KYC risk checks that you would see, right? That this real customer is engaging in this financial transaction, or at least a transaction for financial benefit. But can we find if there are risk signals there? One effective one that we found is if a customer is making more than around 1% of their total disposable income, and having this information get in a variety of ways, in a non-standard way, there may be a kind of a pre-notification, right? We're hearing stories of elderly customers making, normally on a fixed income, maybe $1,000, $2,000 a month, and they're spending $700, $800, $900 cash transfers for cryptocurrency or financial instruments, gift cards, that would be pretty abnormal overall. So if we find those events, we actually see that they're about 5x more risky than the overall baseline fraud rate. So large opportunity for coaching with that customer, coaching staff saying, hey, if you see anomalous transactions, we're definitely protected from a risk area, right? That customer initiated that transaction. But just from a public good, there may be opportunity to provide and delight that customer experience. Say, hey, walk me through why you need $1,000 of gift cards, or walk me through why you're transferring $1,000 to the Philippines today. And that maybe can help prevent, like, if you talk to someone about this, the Elder Abuse Prevention of Ontario has a lot of good strategies here. That said, how can we pre-identify those versus a customer who's elderly who just does want to send, $1,000 to France, right? Where that's a pretty normal transaction. Doing that in a programmatic way can be really helpful. Overall, the interesting part here is that we're seeing about a 25% lower perceived risk for respondents over 65 for phone scams and other kind of investment of where they're being defrauded. They're much more concerned with online interactions versus stuff they get in the mail or text messages or over the phone. Despite their significantly lower risk for getting scammed, looking at just like a website versus where there's actual risk on that phone or other digital interaction. So all in all, seeing unfortunately sharp rise in this, as Sherol noted. We're seeing bad actors as COVID benefits have kind of that money funnel has been shut off. They're taking that expertise and stuff they've learned and pointing it at other problems where there's maybe not the level of sophistication for prevention. And so we're starting to see more of this kind of somewhat first-party fraud where they're actually getting defrauded, where your business is just a conduit for that bad behavior. So in a somewhat similar vein, we want to talk a little bit about multi-factor authentication because we are seeing some of that bad activity move elsewhere. So what types of multi-factor authentication does your company use? Things this is kind of the knowledge part of a MFA, like a password or a PIN. Things you have in your possession, that would be like a badge or a smartphone, some kind of device. Inherent, these are things about you that hopefully no one could replicate. Some combination of the above or none of the above. I'm always curious to see kind of where these land out, and especially the separation by vertical, as we're going to get into. There's some real risk depending on your customer value of what kind of MFA strategy you use. We'll give people a couple more moments. So see those rolling in, combination of the above with the leader at things that you have knowledge of, like a PIN second to that possession, and lastly, inherent. A couple none of the above at about 2.7%. Overall, we're seeing a definite move away from just password to a combination where it's password plus PIN. And then people at the cutting edge are really into this inherent part of looking at finger or voice print recognition. So we're seeing a lot of people are starting to use MFA. That said, a lot of that MFA structure is generally coming from SMS or other texts are commonly used to send MFA tokens, where you log in, you get texted a SMS PIN, and you use that to authenticate towards that website. While this has historically been really successful and has limited a lot of the account takeover and negative externalities of kind of weak password spraying, data breaches, that kind of stuff, for kind of leaked passwords when we see kind of passwords get where they're not supposed to be. Looking at that, though, the challenge is the backbone of how we all receive text messages is really based on the SS7 network. So it's a protocol used that lets us kind of move between kind of the global network. So if you're a Rogers, you can still text somebody in the United States that has a different system as a whole. It allows the interoperability of networks. We actually see that bad actors can kind of take advantage of this MFA loop the reason we're starting to see a lot of SIM swap activity and have historically is that a lot of providers of kind of accounts are using SMS verification as a way to confirm identity. Well, if I can log into your account, but it's sending you a cell phone ping, what if I take your cell phone? And a big part of that has been SIM swap. So what bad actors can do is they actually can take advantage of some of these network vulnerabilities in SS7. It was designed way before people were using this kind of protocol for security reasons, so it's somewhat lacking. And so it's globally based, and so bad actors can kind of create a fake cell phone tower and interrupt or intercept information about your phone. So like location, call interception, so you could actually listen to a phone call. And the most concerning one in this area is text and SMS interception, meaning we can pull down those SMS tokens over the internet by just creating one of these fake cell phone towers. They're illegal, but they're only a couple $1,000s to buy one. Because of many areas like this in 2017, this was actually got into the government overall, that they were quite concerned about this and kind of closing these vulnerabilities. It doesn't appear that a ton of progress has been made on these globally for closing this. And the actual Center for Cybersecurity issued a guidance in 2022 against using SMS-only verification. The CRTC actually logged more than 24,000 cases of port and SIM swap fraud in less than 12 months. And we're starting to see about a 50% increase in year over year in people using MFA, which is great. Adoption of MFA is critical to kind of maintain personal security, as well as overall prevent this kind of activity. That said, about 35% of people believe these SMS pins are the safest way to confirm. So it's not very challenging for bad actors to use these SS7 attacks to kind of take over high value accounts, right? Your Timmy's account, probably not worth the the $2,000 SSS or SS7 fake cell phone tower, but your bank account, credit accounts, cryptocurrency, these are real targets for attacks. So even though your customers are maintaining best security practices using MFA, for especially high value accounts or particularly vulnerable people, this is still a concern area. And so the future is, can we do MFA maybe without leaning on telco, right? This SMS. Can we maybe send a SMS, but get a secondary layer of authentication from that customer, so they have to both have the cell phone and have some additional information about that customer. So big challenges around the MFA side, just from the nature of sending and receiving text messages. On a secondary level, we're also seeing insider attacks. So not only are we seeing vulnerability in people generating fake cell phone towers to intercept your text messages, we're actually seeing phishing scams actually used to generate insider attacks. So again, SMS is a common form of MFA. We're actually seeing bad actors use that vulnerability to sell insider privileges. And so in the darker corners of the internet, we're seeing screenshots of access to, kind of that manager level in an individual store, selling access to changing the SIM of an individual user. So for a couple $1,000s, I'll change a bunch of phone number SIMs to a different SIM ID. That would allow you to actually kind of perpetrate these attacks. And we're seeing, in that first example, $36 million in that SIM swap attack for a single customer. And so large risk area here. And so we're kind of battling customer expectations around MFA with some technological barriers and some either from outside, right? We have some vulnerability in this protocol that everyone kind of has to use, and some vulnerability, some personal security, right? If we close the security gap outside, we also need to kind of think and close that security gap inside. So overall, some material challenges around MFA. So looking at those higher level, can we get information about that customer, and the inherent part of passwords or MFA that is really challenging for someone to replicate. That said, bad actors are moving that direction as well. So if you're following that stuff pretty closely, you'll start to see 3D printed fingerprints or AI voice augmentation. And so always important to kind of think a step ahead, especially as the value of individual accounts grows, right? Lower dollar value, less concerning, right? That $10,000 probably not worth it. But we start getting into financial accounts starts to become a material risk.
I'm going to jump right in here. My name is Julie Kuzmic, and I spend a lot of time thinking about consumers from a number of different angles. I'm responsible for compliance here at Equifax Canada with our regulators, as well as consumer advocacy within the business, where I focus a lot on the actual consumer experience and trying to help people understand their credit, their fraud risk, in order to be able to navigate their personal credit situations with more confidence. So one of the things that we've done for the last several years is take a pulse of where people in Canada are at when it comes to fraud. What are people actually picking up from all of the media stories? Where are people concerned about what their own fraud risk might in fact look like? So this year we conducted another online survey. This one was of 1,000 Canadians. It was conducted by Leger, and that was between February 1st and 8th of this year. So just in the last month or so, we took this pulse. The number of survey respondents indicating a feeling of vulnerability while they're online grew from 78% last year to 85% this year, which is quite a notable difference. We also found that the gap between women and men has narrowed. So men are still slightly less concerned. They moved from 75% in 2021 to 73% in 2022, and now 82% in 2023, while we saw women maintaining the upward trajectory of concern around fraud online. So those numbers over the last few years have gone from 80% to 83% and now 88% in 2023. So when we ask people what actually concerns them about fraud, when they think about potentially being a victim of fraud, where is the concern for them? We're seeing a pretty standard set of answers that's not changing that much year over year. So you can see the list here of the concerns that consumers have. So they're worried about a computer virus or some form of hacking, a security breach at a retailer or a business that they interact with, online payments, phishing emails, as well as the risk around completing online applications using their own personal information. Now, one of the questions we always like to ask is to get a sense of how many people out there think that identity theft or fraud is something that would happen to someone else. It doesn't happen to people like me. We've seen some interesting fluctuations around the number of people answering yes to that question. You can see in the bar graph here, the number of people who think that identity theft or fraud is only likely to happen to other people has gone up and down a bit. We were a bit surprised last year to see that it jumped from 11% up to 16%, but then we have seen that start to go down 14% in the most recent survey. So I'm relieved to see that fewer people seem to think that they somehow are immune to identity theft, while it's a problem just for the rest of us. When we compare the actions that people take to protect themselves across generations, we see a really interesting difference between the younger age group of 18 to 34-year-olds and then the older age group of above 55. So when we look at that difference in attitude between fraud and identity theft, the number of people saying, I feel vulnerable to fraudsters and identity thieves, it's 53% overall. But when we look at that younger age group, it's 48%. And when we look at that older age group of 65 plus, it's 54%. So you do see that that older age group is more concerned about identity theft and fraud. Now, one of the things that we might consider when we look at the differences in these numbers, so you can see that, for example, changing online passwords more frequently. You've got actually the older group that is saying that they are changing passwords more frequently. The younger group is less likely to be doing that, which might not be the response that you might be expecting. You might think that, well, it's older people, don't want to go online, they may not be as comfortable with changing passwords and so on. So a possible takeaway here is thinking about how businesses, how you're tweaking your messaging to your target client for your specific product. Maybe it's a slightly different tone, a slightly different message. Maybe it's presented in a slightly different way, depending on the demographics and who your target customer is or who your customer base is for different product lines that are currently available. There were some pleasantly surprising results with some of the new questions that we added to the survey for last year and followed up with this year. So last year we started the line of questioning around, do you consumers actually feel that you share some responsibility for preventing fraud and protecting your personal information? Or do you feel like it's all on the business, it's all on the bank or the telco or organization that I do business with, they have to do all the protection? 83% of the respondents agree that they do share the responsibility for protecting their own data. And that's up from 87% last year on that same question. So that's an encouraging result. We saw that 80% agree that it's really up to me to protect my own personal information, and I need to do more to protect my personal data. That's up from 78% last year. Exactly half of the respondents agreed with the statement that data breaches are just a fact of life. Last year, it was slightly lower at 49%, agreeing with that statement. And even though 93% of the respondents agreed that they share responsibility for protecting their personal information, that same number, 93%, say that companies need to do a better job protecting their personal information. And that number has increased from 88% last year. So it's an interesting juxtaposition there. More people are agreeing that they share responsibility, but at the same time, more people are saying, but the companies that I do business with need to do a better job of protecting my information. Something most people agree on is the statement that the government needs to do a better job educating people about ways to protect their personal information. 86% of respondents agreed with that statement. Now, here's one of the interesting things about that. I'd be interested to know how much people actually pay attention to advertising from the government or information campaigns from the government. I know that the Financial Consumer Agency of Canada has put a lot of effort into educating consumers and trying to help people be in better positions to grow their own financial resilience. I can't help but wonder if this is a bit of a McDonald's situation. And what I'm referring to here is a fairly well-known scenario that happened several years ago where McDonald's was polling a number of consumers asking if people wanted to have salads on the menu. And they got an overwhelming response that yes, we absolutely want to see salads on the menu. When we go to McDonald's, I want to be able to buy a salad when I'm stuck dragging my kids to McDonald's. I'm sure that never happens to any of you, but that's an example from my own personal life. However, when the rubber hit the road, when the salads appeared on the McDonald's menu, people weren't buying them. People were saying one thing, but they were actually doing something else. So that's where you start to get a lot of interesting behavioral economics factoring into how people actually behave. So many of us like the idea of salads on the McDonald's menu. So I know that if I'm feeling a need to feel a little more healthy, I'd like to order a salad. But every time I end up there, it ends up, for some reason, just being a quarter pounder that ends up on my tray. So I can't help but wonder how much people would actually notice or respond to additional education from the government, but an interesting question nonetheless. So finally, the question about the common policy amongst banks to refuse protection for any type of fraud in the case that the account holder has shared an online banking password, even with a spouse. 57% agreed that that makes sense, that policy makes sense, and that's an increase from 53% last year. So we're seeing some interesting sentiments here. If consumers agree that they share in the responsibility for protecting their own information, are they actually willing to accept the friction in their online interactions that more fraud protection can potentially introduce? Overall, 87% of the respondents actually agree that, yes, I'd be more likely to choose an organization or a retailer that has multiple steps to protect my personal information. And that's up from 78% last year. So quite a jump there in the number of people who are willing to accept that friction. We added this new question from last year to find out what people believe the safest way is for a retailer or an online bank to confirm their identity. And you can see how the numbers break down here. 35%, so the majority of people feel that PIN codes sent to their mobile device, so that multi-factor authentication that we were just hearing about from Brady, 35% agree that that is an effective way of protecting their information. Interesting number there, 24% confirming that personal questions that only I know the answer to, so that's where knowledge-based authentication comes in. Same number agreeing with physical biometrics, but it really drops down to 4% agreeing that over the phone, answering personal questions is a safe way to confirm your identity with a retailer or organization that you do business with. Here's another really interesting question that we introduced for this year. Given the economic circumstances, we're wondering whether there might be more people who believe that it might be okay to do something that they might consider to be just mildly fraudulent. So maybe just changing the salary on your mortgage application because you're pretty sure you can make the payments anyway, or providing a little not entirely true information on your cell phone application because people think that, well, why do you need to know that information anyway? So we asked this question. In light of the pandemic and the current economic situation, do you think that people who normally wouldn't commit fraud may be tempted to commit fraud due to the current economic conditions? The number of people who agreed with that was 75%, which I find to be quite staggering. That's almost like saying 75% of people are almost saying that they might be willing to do something that they might consider borderline fraudulent because of the difficulty of the current economic circumstances. When people are asked about fraud in general increasing, 82% believe that fraud will increase because of our current inflation, interest rate, and economic conditions. So in summary, what are we looking at here when we think about what consumers think when it comes to fraud? Well, thankfully, we are seeing that most people do take the threat of fraud and identity theft quite seriously, with a fairly consistent increase in concerns as you move up progressively through the older demographics. 86% agreed that the government should do more to educate consumers. So some interesting conversation possible around how to bridge that possible education gap. I think one of the major highlights here is the importance of targeting your messaging and your communications to the population segments that your specific products are servicing, both to help them understand what you are doing today and how they are protected today, and the effort that you are putting in to protect them, as well as to help them understand best practices for how they can help keep their own information safe as well. And finally, consumers may actually be more willing to accept friction than we think they are if we make sure that we put that effort into education and context around why certain types of friction may be introduced or increased in certain interactions with consumers. So with that, I'm going to pass back over to Sharol, who I think will be looking into some of the questions that have come in during the session. Over to you, Sharol.
Perfect. Thank you, Julie. That was quite interesting and really ties in well with what we've talked about today with the overall trends that we've been seeing, as well as Kount. And I was quite interested in one of the comments that you made in terms of how much friction consumers are willing to accept. I found that quite interesting, and certainly the fact that it has increased. I think you had mentioned about 87% would be willing to choose an organization that took multiple steps to identify them and to essentially keep them safe. And maybe I'd like to pose this question to Brady, and I do know we have some questions here as well I want to get to, but one that kind of ties into what we've all talked about is multi-factor authentication. So I know there's some questions around what are some of the best practices. So Brady, I wonder if you could maybe share what you would say are some of the best practices and tools from a multi-factor authentication perspective that you've seen in the industry.
Yeah, so a big part of this is I think we should mostly presume that our passwords are shared, especially if you reuse passwords. Your password is no longer like the gatekeeper it once was, right? So to that end, if we have high value accounts, it's really best practice to have MFA, but there's some range there, like I just discussed. The big move in the industry now is some kind of inherent MFA where you actually have to have real possession of maybe the device that set up the account or a device that was provided to you. You know, classically, this was like an MFA token, right? You'd get a little dongle and it would send a code and then that code would communicate. The problem or challenge is customers are not really interested in hyper friction, even for like really high value accounts. And so that may not be appropriate to have a Equifax dongle, right, overall, or some kind of MFA dongle, where we have really moved to the phone. So best practices, you know, can we provide MFA while not leaning on an SMS or a cell phone, because there are some challenges there, right? Either from an internal risk or from a network security as a whole. And so we're seeing people move towards app-based authentication for MFA. So you still get to use the phone, but you don't actually have to have the network issues, right? Some people are moving to inherence, where you have to actually scan the fingerprint, scan the eye, do a liveness test for visual. That kind of stuff is not quite at consumer comfort level, right? We noticed in the survey, you know, a lot of people are very comfortable with this SMS method. So can we have an SMS method while still getting some of the inherence stuff, right? So can we know that this is the device and deliver that MFA that way? Or based on that SMS, can we, you know, send you somewhere where we can do an MFA based on inherent?
Perfect. Thank you, Brady. Apologies there, just having a little trouble unmuting. Now, with that, I'm going to take a look at some questions. I think we have time for maybe one or two. I do see one here in regards to one of the slides we had looked at. And the question is, what is the relationship between identity fraud and unsecured lending demand? And I think I did talk about that quite a bit through a number of the slides. So maybe if you think back to the pandemic, and when we saw the COVID benefits being offered, there was a huge demand and increase, which we saw in new accounts being opened. And this was to allow the facilitation of the funds from the government. So what we saw because of this, the creation of these new funds, well, fraudsters took advantage of it. So we saw significant spikes in application volume for new accounts, new deposit accounts. And that was, again, a huge increase in fraud around third-party risks, the same thing that we are seeing right now in regards to unsecured lending. So what the fraudsters will do, they will move to the path where they can leverage the same tools, the same behaviors, and sort of mask themselves as normal. This is what we're seeing in unsecured lending. So because of the economic situation, there is an increased demand from consumers, and fraudsters are taking advantage of that. So they then are leveraging same tools and patterns that they did before for deposits, and now utilizing those same behaviors essentially in the unsecured lending world. Now, let me see if we have some time for another question. So I do see, sorry, just having a little issue moving this here. So I see a question here that's popped up. Is Equifax planning to implement any further solutions to counter fraud? So thank you for that question. I think essentially looking at our overall roadmap from a fraud perspective, there's a number of things that we are looking at doing from an authentication perspective. We are looking at enhancing different solutions in terms of some of the things that Brady talked about, some of the best practices from a multi-factor authentication perspective. Those are some of the enhancements we are looking at on our roadmap, as well as different ways to try and address third-party and first-party fraud, whether it's through leveraging new scores or leveraging, again, some of the information that we've shared here today. We do have, through our fraud exchange, the ability for you to identify and hopefully stay on top of some of these fraud trends that we have been seeing. Happy to share some more. Feel free to reach out. Now, with that, I do see that we're sort of near time. So there are still a few more questions. What I will do is work with the team, ideally, to go through some of them. And as we mentioned, where we can, we will capture some of that information and provide it back in some Q&A. So thank you for that. I do want to thank Brady and Julie. A lot of great information, and certainly interesting to see how it all tied together. And I think we'll have some time maybe in the year to come back and maybe share where we're at that point. Now, with that, thank you to everyone. I do want to give you just a little quick reminder that at the end of the event, there will be a post-event survey. I am asking that you share your thoughts and give your feedback. What would you like to see? What could we do differently next time? But please take your time and fill out the survey. We would appreciate that. As well, on March 7th, we do have our consumer trends call. I ask that you register. A lot of great insights, and you certainly start to see some of the patterns and trends and how they align from a consumer even to a fraud perspective. So thank you everyone for joining our webinar. I look forward to your feedback. Have a great day.